Hey, folks, welcome to InTheMoneyStocks.com's verified investing alerts. My name is Gareth Soloway, Chief Market Strategist here at InTheMoneyStocks.com. Today's date is Friday, February 19th, 2021. All right, folks, let's get right into it here. I want to talk about the 10-year yield. The 10-year yield continues to spike higher, currently trading above 1.32%. This is just the beginning, folks, all right? When you print as much money as we have printed as a country, whether it's the Federal Reserve with quantitative easing since really 2008, 2009, nonstop flooding the market with liquidity, or if you look at the government, which is now on the verge of another $1.9 trillion package, it is going to create bubbles. Those bubbles, not only debt bubbles, but also equity bubbles. We see it in the markets. We see it with GameStop and Tilray's recent run and AMC and all those names, and even equity valuations where the S&P PE ratio is getting to absurd levels. All right, it's because interest rates are near zero, money is free, and it encourages people to basically borrow money and put on risk, right? There's no other place to get it but if you go in the stock market or the debt markets, all right? So bottom line is yields are going to rise. Why does the 10-year yield have to rise? Well, because people are going to be less and less likely to lend you money unless you pay them a higher interest rate, all right? So people are looking at the United States and saying, okay, they're printing money left and right. They're never going to be able to pay it back. Therefore, we need to demand a higher interest rate. So even though the Fed doesn't want higher interest rates, the market can actually force it on the Fed, and that is what is starting to happen. So you can see clearly on the 10-year yield here, we've already had a dramatic move from the lows. We're right here at this 1.324 level. This is your next stop. See this pivot point right here and this pivot point right there? That's right around 1.5%. That is likely where we will go, and we could be there as early as next week, folks. All right, if you look at where we were at the end of last week, yields were at 1.2%. We're almost up 0.15%, another 0.15%, and we'd be at 1.5% next week. So that is going to be an issue. Now, the higher yields go, remember, money is going to come out of the stock market at some point. All right, and the reason you know that is because if you look at what the Fed did by pushing interest rates down, it pushed money into the stock market. All right, that's why we are where we are. Now, as interest rates rise, which is the reverse of what the Fed did, the classic idea is that it will unwind itself. Now, it's not going to necessarily be right away, all at once, but it will happen as yields rise. Every 0.1% that yields go up, there'll be a little bit of money that comes out, and obviously that will get a little bit heavier as yields get higher, meaning more money will be pulled out the higher yields go every 0.1% or so. All right, so clearly 1.5% is the resistance. If you get through that level, 1.95% is your next big level, just under 2%. My guess is this 1.5% is where you're going to start to see money really pile out of the markets or run from the markets. The reason I say that is because if you look at the yield, the dividend yield on the S&P, guess what it is? It's right around 1.5%. So basically, once you get to 1.5% on the 10-year, the yield is the same as the S&P. So a lot of these pension funds and mutual funds that think the markets are overvalued, which they are, and they see the writing on the wall, they're going to say, well, listen, if I can get the same yield from the 10-year that I can from the stock market, why am I taking risks of losing 20% on my stock portfolio? And that's the mindset that they're going to come to school with, essentially. Now, as we climb higher, you'll see that dramatically increase. 1.95 is going to be your next spot. Now, let's take a look at the gold chart, right? Because the gold chart is going to be very, very important here, I do believe. And just let me bring that up here as we speak. Bear with me. All right, so that's the 10-year, and again, let me just go back to my gold chart here as we go into this. And there's the gold chart. And basically what gold's doing here is, now gold to me is a huge buy, all right? So you can see right here, if you go back to 2012, pivot high, pivot high, pivot high. That's basically what we're hammering on right now after this big move up on the gold futures. And the key here is to understand that on this chart of gold, you're replicating what you did in 2008, 2009, just before gold broke out then. All right, basically what you did was you made a new high from the 1979 high on gold. All right, then you pulled back basically a 382 Fibonacci retrace, which is exactly from this high to these lows, 382 retrace, and then you started to soar to the upside. So that's exactly what I'm expecting on this chart of gold, and gold to me is a no-brainer. The more printing of money, the more inflation, gold is going to be the hotspot. Now, we just saw Bitcoin hit a $1 trillion valuation. That's impressive. That is overdone. That has become a kind of a bubble, if you ask me. And basically what you're going to see is an unwind of that at some point. Now, do I like Bitcoin long term? Yes, I love Bitcoin long term. Would I buy it here? No way in hell. All right, there's no way I'm chasing Bitcoin up here, or I would recommend that anyone chase it. You will have a big corrective move on Bitcoin. Bitcoin has had 50 to 60% corrections many, many times throughout its history. It will have another one. Wait for it to pull back, in my opinion, down to about 20,000, 22,000, and it will do that, and then buy like crazy. All right. In the meantime, when money comes out of Bitcoin, you will see gold move higher. All right. There's no doubt about it that gold and Bitcoin are now competing for the same money. All right. So eventually they will move together, but in the short term, people are pulling money from gold and pushing it into Bitcoin, and that is absolutely happening. There is no question. I've talked to many fund managers who are saying, hey, listen, I had this much money in gold, but now I got to diversify with some Bitcoin. All right, so I'm taking some of that money and putting it into Bitcoin. All right, now again, I don't recommend that at these levels, but that is absolutely what's going on. So again, gold to me is an accumulation here. Keep accumulating it. If it comes lower, accumulate it more. Look for a breakout. Next target is going to be about $2,800 to $3,000. I think that hits within 2 years from now, maybe less. So you're talking about potentially over 50% upside in gold just in the next couple years. All right, bottom line is come follow me at Gareth Soloway on Twitter. If you're interested, come to my website, inthemoneystocks.com. Look for my name. There's a drop down with my 2 services, verified investing alerts and verified options. Join them. They're a no-brainer. Profits continue to flow. I will see you guys soon. Take care.